What's going on, y'all? Welcome back to the channel, Wealth Hacker Labs. As you can see, we have another special edition of the Wealth Board. And today, as you can see, we are talking about investments that give us high return with little to low risk. But the one thing you have to realize is that risk is relative. So what is risky for you may not be risky for me. What is risky for me, vice versa. And for me, one of the ways I've always found this out with working with clients and just talking to people that are wanting to invest and understand what risk means is you've got to quantify it. You have to figure out what does that mean dollar-wise. So if you're investing $100,000 and you say that you can stomach a lot of risk, like you don't mind risk, you just want to put all your money into risky investments, and yet if the market is down or if your investment is down, say 20%, so that you lose $20,000, like now we're talking real money. And that's one of the simple ways that I have quantified for people trying to understand like what is risk and how is that relative to them. All right, so that being said, we're going to take a look at 8 different investments that can offer you high return with little to low risk. And once again, risk is relative, and we'll talk about that as we look at each of these investments. But the first one, as you can imagine, the first few are going to be somewhat boring. But the first one that we have are high yield savings. You could throw high yield checking in there. I mean, typically, as you can see, that's not going to pay you a lot of money. I talked about this on another Wealth Board video. But right now, you can expect to make anywhere between 1.8, maybe as high to 2% on some high yield savings. One of the ones I've mentioned before is Goldman Sachs has their Marcus savings account currently paying at the time of this recording about 1.9%. And then you have Robinhood. It's not so much a high yield savings, but they have their cash management program that's paying, once again, at the time of this recording, about 1.8, 1.85%. And there are several others out there that are going to pay you something similar. So yes, is that high return? Well, compared to the 0.05% that some banks are paying, yes, that is high return, but not the 20, 30% return that many people are hoping to make in the market. So what is on looking at number 2? So number 2, we are looking at short-term bonds. And once again, these are not super sexy. You sexy thing, sexy thing. They're kind of boring, but they can pay a little bit more. And there's a few different ways that you can go about this. Now, when I first started in the industry as a financial planner, many people bought short-term individual bonds. So we're talking short-term corporate bonds, like 3 to 5 years. There typically weren't muni bonds that were short-term, but it could have been government bonds like Fannie Mae, Freddie Mac, those type bonds in that 3 to 5 year range. You can also buy mutual funds. Mutual funds have short-term bond funds that you can buy. You can also buy short-term bond ETFs. And I would say these are probably the more popular options that you are going to see nowadays. So some of the options that you can buy, iShares has their short-term bond fund. Vanguard's got a few short-term bond funds. I'll give you one symbol that you can take a look at. It is BIV. So that is the Vanguard Intermediate Term Bond Fund. And at the time of this recording, once again, it's paying you about 2.52%. So yes, a little bit more than high yield savings, not a lot more. You are, I'll say, tying up your money. It's not like we're putting money into a CD, but you can still stand to see some risk. So if we see some move in interest rates, if interest rates start creeping back up, you may see a small dip in your principal. So please keep that in mind. So those are the first 2 options that we're looking at. The third option are tips. And no, we're not talking if you are a server or waitress, waiter at a restaurant, getting those tips. If you're a valet driver, we're not talking about those type tips. We're talking about Treasury Inflation Protected Securities. So typically with these, there are a few different ways that you can get these as well. You can go and buy them online at treasury.gov. Typically, they are going to be released in 5, 10, 30 years. Now, if you're going to tie up your money for 30 years, I don't think I'm doing that with a tip. I'm just saying, especially right now with low interest rates. And you could also buy, there are ETFs that you can buy. There are mutual funds that you can buy. So there are several different ways that you can buy it. But right now, interest rates really on these aren't all that impressive. You're still looking at that 1.5% to 2% range, depending on how long that you tie it up for. There was a time that these were more impressive. They are meant to keep up with inflation, so there's that. Obviously, you got the backing of the government, and however you feel safe with that. You know, there's some people like, no, that is not safe. But other way, you know, it is backed by the government, so that is an option that can give you high return with basically no risk. All right, the fourth option, now we're talking about options that are probably a little bit more exciting. We have dividend paying stocks. So now we're talking, get into the stock market, try to make some money, making that money, investing in the stocks. But we are looking at dividend paying stocks. So for those that aren't familiar with the dividend, if a company reaches a point where they are cash solvent, as a reward to these shareholders, they can pay in the form of a dividend. You know, you have two different ways to make money in the stock. You have appreciation. You buy a stock for $10. It goes up to $20. That's appreciation. You also have the dividend. So here's some examples of some dividend paying stocks that you can buy. You know, typically you're looking at stocks in the energy and utility sectors. Typically those are, not always, but do have some stocks that are going to pay higher dividends. But just some examples you may be familiar with. You've got Chevron, currently paying about, 3.93%. And then Verizon. Can you hear me now? Can you hear me now?
Can you hear me now? Can you hear me now? Can you hear me now? Can you hear me now? Can you hear me now?
Verizon currently paying about 4.15%. So that's pretty cool, right? So you're putting money into stocks, and even if the stock doesn't make any money, if you buy it for $20 a share and it stays at $20 a share for that entire year, you didn't make any money on the appreciation part, but you did get paid in the form of a dividend. So another strategy that's with this strategy, dividend paying stocks, is that you can look for stocks, and there are a few different names for this, but one common name that you'll hear are the dividend aristocrats. So what is that? So basically that is looking at stocks that have a history of not just paying a dividend, but also increasing their dividend over time. And I was looking up, just researching for this video, and I found a list on Kiplinger's. I think it was 15 or 16 stocks that have never decreased their dividend in like the last 55 or 65 years. I'll have a link to that article in the show notes so you can take a look at that. But just some examples of companies that have not only paid a dividend, but have never not paid a dividend or cut their dividend. Some big companies you are probably familiar with. Johnson & Johnson is one. I should put J&J. And then you got Coca-Cola Classic. And right now, so their dividends are paying, Johnson & Johnson is 2.6%, and then Coca-Cola is 3.5%. Not that bad, right? We've got stocks that not only pay dividends, but have a history of increasing that dividend. So you're just increasing that paycheck that you're getting. Now, I do have to say, cue the editor, put the disclaimer at the bottom here, past performance does not guarantee future results. So just because they've always increased their dividend doesn't mean they're always going to, but nonetheless, it still gives you some peace of mind knowing that they have a solid history of doing so. All right, moving on to number 5, we do have stocks again, but a different type of stock. We have preferred stocks. So what is the difference of a preferred stock as opposed to some of the dividend paying stocks I was talking about before? Well, so these type of stocks is what we would call common stock. And with the preferred stock, they do have some VIP status when it comes to shareholders. So with preferred stock, you don't get any voting rights. So, you know, if you are a shareholder and you buy Coca-Cola, you buy any of these stocks, and, you know, you have voting rights. But with preferred stock, you don't have voting rights, but you do have access to those dividends. So if a company is going to cut the dividends, typically the common stockholders are going to get their dividends cut first. Preferred stockholders are going to get paid first. And a preferred stock is a hybrid between a stock and a bond debt of that company. So if you kind of think of it like that, like it's a stock, but it also pays a dividend. It typically is going to pay a higher dividend than what you're going to see with other common stock. And here's the other kicker too, is that just as an example, Alcoa is a company right now that if you buy their common stock, there is no dividend. So all you can hope to make money on is that appreciation. But if you buy the preferred stock, right now the coupon payment is 5.375%. So just under 5.5% you're going to get on the dividend payment from the preferred stock. But if you own the common stock, you get those voting rights, but you don't get no dividend. So however you want to slice it, whatever you're looking for, a lot of people do like having that preferred stock just to get that reoccurring payment of that dividend. All right, moving on to number 6. Number 6 are annuities. Woo! If you are 30 years or younger watching this video, don't buy an annuity. You don't need an annuity. I don't care who's selling it to you. I don't care how much you like them. You don't want to buy an annuity. It's not for you. There are a few different types of annuities that you can buy out there. You'll hear fixed is what we're talking about here. There's also the indexed annuities. You've got variable, deferred. I mean, there are tons and tons of them. I could do a whole other wealth board video on annuities, and I may well do so because I see a lot of bad information out there. But with annuities, so let's just talk about fixed annuities. Right now, a fixed annuity is similar to a CD in that you are guaranteeing a certain type of interest rate for a certain period of time. But, and there's a huge but, and please editor, can you put a BUT really big right now? But the big difference is that if you buy a CD from a bank and you decide to cash out early, the only thing that you have to pay, like your penalty, is you are giving up any interest that you would have accrued. With an annuity you buy from an insurance company, you may be giving up your principal, and that is a big difference. We're not talking about giving up interest, we're talking about giving up principal. You don't want to do that. You don't want to have to pay a surrender charge just to get your money back. But that is typically the case for a lot of these annuities, so please be careful. Make sure you read the fine print. And right now, I just checked, look at some different rates. There's a 5-year option and a 10-year option. And I think they're about the same. This is the funny thing. So the 5-year option is 3.9%. So if you are in that age or demographic where an annuity makes sense and you are totally fine making 3.9% for 5 years, make sure you compare that to a bank, an online bank, I don't care, and find out and make sure that this is paying substantially more, because I'd rather go with the CD than the annuity. But check this out. If you want to buy the 10-year, like you think you get paid more, right? But currently right now, the 10-year annuity, fixed annuity, is paying about, 4%. So, 5 years, 3.9, 10 at 4. Which one am I going to do? I hope you know the answer to that. So yeah, so this is another option. We can get high return. Now with the index, a variable, there are so many different moving parts with these, but the idea is that you can have some market participation and limit your downside risk. That's kind of the pitch with these. I want to be careful with that because there are, as I mentioned, there are a lot of moving parts. It can get confusing. Most people that buy annuities have no idea what they're buying because they were missold, misrepresented. I need to do another video on that, so I will. All right, so moving on, number 7. Number 7, this is one that I've had my money in for quite some time, and that is with LendingClub, otherwise known as P2P, peer-to-peer lending. So I have a few different accounts with LendingClub, and the oldest one that I've had, I've went from being conservative to a little bit more aggressive, and as of right now, I have one account that has paid me about 5.36%. I have a few other accounts that are greater than 7%. I don't know if enough time has passed to some of the loans to default on that to affect that rate. So keep that in mind, but I have talked to other people, actually many of you that have commented on other YouTube videos talking about how much you've done, how well you've done with LendingClub. I mentioned LendingClub again just because at some point in time, like we're going to have a correction, right? Like the market's going to have a pullback. And if you're making between 5 and 7% in what I would call the equivalent of a bond or some sort of bond equivalent, like that's not too bad. So that is just one area to consider. LendingClub, peer-to-peer lending, there are others out there, but there's no question that LendingClub is still the leader in that peer-to-peer lending space. All right, the last one, Fundrise. Let's have some fun with it. So we talked about peer-to-peer lending. Now we're talking about crowdsourcing with real estate investing. And I have other videos on Fundrise. You can check those out. And I've had a few different Fundrise accounts. I think the longest one I've had, it's been a few years now. And when I looked at the return, you know, I'll have a screenshot that you can check out here, like the different type of investment strategy that they have. But the overall weight on everything, my total portfolio has paid about 6.6%. And I don't think it's been 2 years. I think it's just over a year and a half that I've had that. And with that, I always remind people that, you know, once again, like the stocks, the two different ways that you make money are appreciation and that dividend. And with real estate investing, the two ways you make money is with rental income or also that appreciation as well. And if you are investing in real estate, like we're not flipping properties right now, you know, this is a long-term investment. So the fact that we've made 6.6% just off the dividend yields and payments from Fundrise, managing all their portfolios and doing all that on my behalf, like that's not too bad as well. And I know that's attractive for a lot of people. I know many of you have tested out Fundrise and you've had good success with it. You know, with all of these, I mean, these are all just options that you have to make high return with little to no risk. Once again, depending on what your risk is. For some of you, this might be too risky. Other people will be like, wait, that's all you got? Like, I want to put all my money into crypto, or I want to put my money into penny stocks, you know, and make 100x return. We need to have a talk if that's what you think is going to happen, by the way. But nonetheless, so these are some options that you can make high return with low risk, just making sure you understand what's out there. If you found any value in this, be sure to like, subscribe, and hit that notification bell, because guess what? I've got more videos coming showing you how to accelerate your wealth here at Wealth Hacker Labs. All right, y'all, this is Jeff Rose reminding you that it's your money, it's your life, and only you can make it awesome. Peace.